When we think about the equity volatility, the bond volatility, and at least in the last few days finding some stability, are the equity markets taking their cues from at least recent stability within bond vol and signaling that risk on signal from that?
Well, I do think the yield curve is the most inverted in the swap space. You can see on your Bloomberg terminal, it's over 80 basis points negative. It's the most inverted it's been since the late 80s. And I think the equity market really hasn't picked up yet to how dire the bond markets are pricing. Like, imagine that's the difference between the 2 and the 10-year interest rate in the swap space, which is a global market. We've been hearing a lot about swaps with the UK situation. But most institutional investors, sovereign wealth funds, insurance companies, pension funds, they don't actually pay for treasuries, whether they're gilts or U.S. treasuries or bonds or JGBs. They use the swaps market. And so that market is definitely screaming that the Fed is making a policy mistake. You can see that the 2-year interest rate is 85 basis points approximately higher than the 10-year interest rate. And that is not a healthy sign. So although today feels good, it's been a little bit of a break from the constant slide down in equity markets. I do think the market really is looking to the Fed to so much is priced in till the end of the year. But if the Fed can be less aggressive or maybe use their balance sheet more, that could be a big relief rally potentially, which would be very out of consensus, right?
Yeah, I mean, are you anticipating that in any way, Nancy, or are you worried that there's things that are going to come unwound as they did in the UK that's going to force some sort of change of tack?
Well, I do think the Fed has to be mindful of the global economy and financial stability. And I think there are so many additional Fed hikes priced in. We almost have 2 full 75 basis point hikes priced in. You can see that in Fed fund futures on your Bloomberg terminal just through the end of the year. So I guess the one positive about that is that does give the Fed a little bit of room. If they don't hike as much as what's priced in, that could cause a rally in risk assets.